we're ready for bonds and long-term liabilities. We have 4 exercises. The first one's on bonds and what they cost, or what you sell them for. The second one is how to record bonds with journal entries. The third one is how you can use this information to calculate whether you want to do a bond for investment money or to sell common stock. And it depends on your purpose. And finally, we look at how to read a bond on the balance sheet so that you can understand exactly what they've done and how much the carrying value is. So let's go back up to the top and start with number 1. Number 1 is we write bonds, and when we write them up, they have a maturity value, $300,000, and they have a stated rate of interest and a period of time. Well, the market rate, or the rate of interest for the original bond is not going to change, and neither is the maturity value, or what it's written at. But what does change is the interest rate that it can be sold for on the market. And that happens because you'll issue these, or you'll write them up, and at the time that you write them up, the bond rate may be 6%, as here. But by the time you get to put them on the market, or they aren't bought immediately on the market, they may just kind of, it may take 6 months for them to take off. The interest rate will change on the market. It may go from 6% to 8%. Well, if that happens, nobody is going to buy your bond at 6% if they can get it at 8%. So we do what they call discount. And that discount takes up for the difference in the market versus the effective interest rate. So what you can imagine here is, let's say we had a bond for $300,000. We've written it at 6, okay? But the market's paying 8 or 9. So we've discounted that bond so that it makes up for that difference. So instead of selling it for $300,000 and receiving $300,000, we sell it for 75.75% of that, or $227,250. That becomes the cost of the bond, or, in theory, the carrying value. But we have to record that as $300,000. So let's just figure these out, and that's literally taking $300,000 times 105.25%, 300,000 times 94.5% to find the cost out here. And that's relatively straightforward. What you might also want to do is put the maturity value out here so you can see the difference back and forth. So let's apply this. On January 1st, they've issued 20-year bonds at $70,000 at 9%. And the bonds are selling at 97 or 97% of the bond. And they're paying interest on January 1 and July 1. So on January 1, they issue this, and they are only going to get cash of 70,000 times the 0.97. And that amounts to, well, if you total that out, I think it is 67,900 maybe. Hold on, let's see. I believe if you, yes, 67,900. So that's going to be a debit here of 67,900. And then we always have to record that at, we have to put in, we received 67,900. But I can't change what I have on the face of that bond. I'm going to pay out, that bond payable is actually 70,000. That doesn't change. Now when you have an entry obviously these two do not match and they need to balance, we have a discount on the bond, and that's the amount at 3%, and that's actually considered like I should have received $70,000. I only received $67,900, which means I didn't receive $2,100 that I should have received. But in the end, I'm going to pay out $70,000. This becomes additional interest, and this is amortized or divided out over the life of the bond to be recorded as interest expense. So let's look at how that works. So again, we don't change what's on the bond. We're going to pay out 9% times $70,000 divided by 2 because I'm only paying for 6 months. So I am paying out $3,150. My discount on the bond, which is being amortized, is $2,100 divided by 20, which equals 105 divided by 2, which equals 53. So that's additional interest expense that I'm going to recognize here. So now my interest expense becomes $3,203. So this is gently put into the entire life of the bond instead of immediately taking it out as interest expense at the beginning. And that may change. I mean, it's whether they cash it in early or it's called early, you call it. So you'll want to do that on a yearly basis. So that's number 2. Number 3, we look at this. Now, this is just for comparison or as a guide. The numbers in this have nothing to do with the actual problem. So what we have is they need $3 million, and they're trying to decide whether to put bonds out for it or to issue common stocks. And they are worried about the earnings per share and what that will do to the earnings per share. So let's kind of plug and chug the numbers. They get an expected income of $500,000 from the new expansion. They have interest expense only with the bond, which is 6% of $3 million, which is $180,000. They have a projected income before tax on the. If you add all of this, I guess there's 500,000 minus. This is a negative. Okay, don't forget that. So that's going to give you before tax income right here. So you'll have before tax income. And then you're going to subtract the tax, which is 40%. And that will give you your project income. Now remember, that is to be added to that 300,000. Because so that would give you 492,000 from the bonds and 600,000 from the issuing of common stock. So you think, well, that looks good, right? Well, we have a slight problem. If you're really interested in the earnings per share, you're going to divide the 492,000 by 200 shares, which is what you had originally, and the 600,000 by 300 shares, which you had originally, and look at the difference here in earnings per share. So that's food for thought, and that's why you would do these exercises. Because if you just stopped here, you might go with this without realizing that you're cutting your earnings per share. Which do your stockholders want? And then the final one is just kind of looking at this and trying to decipher what it's really saying. So what's the maturity value of the bonds? Well, how much am I going to pay for those bonds when I'm all done? And I've already said bonds payable never change. So that's 300,000. What is the carrying amount of the bonds as of 2012? And I believe this is as of 2012 here. So the carrying amount is the bond payable less the discount. And then they ask the annual interest payment on the bond. Well, you have 300,000 times 4%. That's going to be your yearly. If it were semi-annually, you would divide that in half, right? And then how much interest expense should the company record each year? Now, this is a little bit tricky because you're looking at the discount at 36,000. There are actually 8 years left in the bond, so you divide that 36,000 by 8 to come up with the amortization per year. And then you can calculate the annual interest expense for the item. So you would probably have 36,000 divided by 8 plus the original interest payment, and that would be your interest expense. Now there's a difference between interest payment and interest expense, and that's what this is kind of showing you. So that wraps up number 3. Email me or message me with questions, and we'll go from there. Thank you.